Terry Smith is a stuff that's been happening. We'll get ourselves started with that one, shall we? So we've talked about the BritBox and the Eurobox recently, and we've talked about our own portfolio. So now it's time to start talking about other people. And one of those people is Terry Smith. He's released his letter to Fundsmith shareholders for the last 6 months, or the kind of first 6 months of this year, and is down about 1.9% over the 6 months. I say he's down. He's not down. I mean, he's collecting fees from this thing, but the people who own the shares are down, importantly, 1.9% on their investment over the first 6 months. He charges at about 1% a year, I think, which is sort of actually reasonably high for a fund that has just underperformed recently a little bit. Long-term performance is still very, very good compared to the thing that he indexes against, which is the VWRL. I tried to check it against the S&P 500 and is above that since inception, not by as much as he's above the VWRL, but he is still outperforming. So still the man. But right now, less the man than he has been in recent years, I guess it's fair to say. So the main thing that's been dragging his performance lower is Novo Nordisk, and we've talked about this a fair bit on the show recently because it's been dragging our performance in the Eurobox as well. Unlike us, Smith says that basically the decline in Novo combined with the size of attribution his portfolio previously had to it, pretty much if you add that and Coloplast, which is a kind of Danish plaster conglomerate, I think, as in sticking plaster, not plastering plaster conglomerate. Between them, those two things basically account for all of the underperformance, which is one way of putting it, I guess. I'm not a huge fan of that way of thinking. I mean, I think your underperformance is a function of all the other stuff you had that underperformed as well. The stuff that didn't go up as much as the BWRP did. But that's his way of thinking about it and thinking, well, if I hadn't been so massively committed to Novo Nordisk and Coloplast, then we wouldn't be underperforming here. And Novo Nordisk has gone from his portfolio. He spoke very positively about it not terribly long ago, but he sees them as now clearly losing in the race for GLP-1 supremacy to Eli Lilly. GLP-1s are a theme that Terry Smith is quite big on. He's also been selling over the past however long his stake in Pepsi, his stake in Brown-Forman, his stake in Diageo, and all these companies that he sees as kind of casualties of people eating and drinking less, and maybe correctly, to be honest. But he's now also seeing Novo Nordisk as a casualty of Eli Lilly being better at stopping people from eating and drinking less. And there might be some merit to that thought. I mean, I know you sold it recently as well, Steve. So I would say you're in good company, but you're at least in the same company as Terry Smith anyway. So we will come back to that one in a moment. I guess the big question that everyone has is what he's been buying. And he's been buying three things as far as I can see. One is Zoetis, which is a animal medicine company based in the States. I always used to muddle this up with a company called Zomedica, which is also an animal kind of medicine company in the States, and very, very different one. In that Zomedica is a crappy meme stock, basically. It went up 270% once because Carol Baskin, I'll just give you a moment, Steve, to remember where you know the name Carol Baskin from. Oh, no, you don't need a moment. Steve, where do you know the name? Carol Baskin is one of the objectionable people in Tiger King, which is another way of saying that she's one of the characters in Tiger King. And she, for some time, gave a kind of advertising plug, I think, for in a way that celebrities do, for money. Nothing the matter with that. For Zomedica, they have, as far as I'm aware, at least at the time, they had no product at all, no revenues, no nothing, and the stock went up 270% before, well, you can imagine how that one ended. But Zoetis is not that. Zoetis is a legitimately pretty good, I think, animal medicine company. EssilorLuxottica, which does exist in the Eurobox, and we were there slightly before Terry Smith this time, is also now part of the Fundsmith portfolio, which is interesting, and they're doing some interesting stuff at the moment with Meta around smart glasses, or at least they're threatening to do some interesting stuff with Meta around smart glasses. Whether that really emerges, we will see, but there is at least a degree of seriousness to that. And Intuit, which is the QuickBooks accounting software thing, because glasses and animal medicine are too exciting, so we're going to buy a tech company, but we're going to buy one that's about accountancy. I have some thoughts about the Fundsmith portfolio for a little bit, Steve, but that's quite enough of me going on for the moment. Did you think anything of either this performance or these moves?
I feel like we can't move on from Carol Baskin as quick as that, especially as she managed to move a stock 250%, and in the same week, I think she was tricked into delivering a birthday shout out to Jimmy Savile and Rolf Harris. as well. So I'm amazed the stock market and the tricks that it gets up to sometimes. But yeah, looking down Terry Smith's portfolio, I think it's quite easy to see why he's underperformed. I still don't really like a lot of the stocks that he holds in there. And throughout this letter, you can see that there's a shortness to it, which kind of shows you that he's sort of losing patience with his underperformance, the macro factors affecting him, and also the fact that he seems to pick companies that sack the CEOs and then don't replace them for long periods of time. You can see that as you read through it. So it's not a huge update here, Steve. I would surprised as anybody that Philip Morris has done as well for him as it has. I'm less surprised that things like Meta and Microsoft and IDEX have done. L'Oreal must be having a decent period because it had coming off the back of a pretty bad period. But yes, Novo Nordisk, LVMH, Coloplast, Waters, and Alphabet have all been a real drag on the portfolio's performance and on my portfolio's performance as well. But yeah, I think it's basically ever since we've been covering Terry Smith, Steve, we've said pretty much the same thing. He's underperformed, and he has an excuse. At the moment, I don't think the funds are being taken away from him. They're not drifting off to other funds. There isn't any funds out there at the moment, Steve, that are really shouting out as the next big thing. So he's keeping his inflows and outflows fairly stable at the moment, but he can't keep underperforming like this, Steve, because it's okay for people to turn around and go, but look at all this outperformance. Well, that's great, but you're not getting that anymore, and you haven't had it for the last 4 years. You can't buy a fund because of its history. You've got to buy it because of its future, and at the moment, I would say, Steve, that Fundsmith is struggling, and I'm not entirely sure that the stuff he's buying gives me the greatest confidence that it's going to be the next leg of growth for his portfolio, Steve.
I find it difficult to see, and obviously this is the case, I find it difficult to see what I'm missing about any of these buys that tells me there's some real insight going on here. They all look fine to my eyes. Now, no doubt there is something about them kind of going on here. And if it were Warren Buffett, like the actual Warren Buffett, not the UK's Warren Buffett, buying these things, people would be crawling, including me, would be crawling all over these to try and work out what the hell it is we're missing. Somewhere in its balance sheet, it's actually got some swaps that it turns out are worth more than the market cap or something. I'm just not driven to do that with Terry Smith in the same way. I'm interested about the shape of his current portfolio, though. So one reason he's been underperforming over the last 12 months, certainly, is that sectors have been doing well that he generally doesn't like. So banks and financials have done very well, and he dislikes those as businesses. Utilities have done very well, and he dislikes those as businesses. Banks because they tend to carry a lot of debt, which is true, and utilities because they tend to be very capital intensive, which is also true. Those, however, have outperformed the S&P 500. They've been some of the leading sectors coming into through the last sort of 12 months or so. And whether you like it or not, if you sit those sectors out, it's very hard for you to keep back up again. Okay, fine. That's the way it is. In the meantime, we've seen his largest two positions become, at least now, Meta at 9.4% and Microsoft at 7.25-ish, slightly more than that percent when I looked at the Fundsmith holdings recently. If he dislikes utilities because they're so capital intensive, it's very much worth noting that Meta and Microsoft are going down that road. They've both announced huge investments in AI data centers, so Meta 72 billion, Microsoft 80 billion. That is more than 50% of each of their current tangible assets, sort of net for depreciation in both cases. In other words, they are sticking big amounts of capital, even by their standards, and their standards are high in the sense that they're big businesses and low in the sense that they're not super infrastructure heavy usually, but they are going down that road. And on paper, at least, that makes them a bad fit for the Fundsmith portfolio. You can argue they're good investments, and I'm very sympathetic to an argument that says they're good investments because they will generate such big returns on these things that you will be glad that they spent 72 billion, 80 billion, whatever the hell Amazon is planning on sending out on these things. Same for Google to some extent. I'm perfectly open to hearing the idea that this will be worth it because this is AI infrastructure and AI is going to be the thing, and we're going to need as much of it as we can get in terms of data centers and computing. But it is capital heavy. It is not capital light in the same way. And I sort of wonder what Fundsmith is thinking about there, because this is, on the face of it, they have a fairly straightforward kind of model. It's not quite as straightforward as screening for things here, but you can get a long way to. They used to broadcast stuff like their PE ratio of their portfolio and the return on capital employed from their portfolio and so on. And these things are either about to grow an awful lot, or they're about to start screwing up their returns on capital employed. And maybe you think it's the first one, but big returns for big investments hasn't really been the Fundsmith style of business. So I sort of wonder about these and how they're thinking about them a little bit. Plenty to like about them, and I've no argument with having them at the top end of a portfolio here. But for Fundsmith, which aims at kind of, well, it attempts to aim at what it considers to be kind of asset light businesses. Exactly how well it hits that's a whole other question. But it's starting to stick out a little bit to me here, Steve.
Well, I was only having this discussion a couple of days ago with somebody on the Trading 212 community who was trying to justify the high PEs that we experienced recently. And they said, well, all of these businesses at the top are different to businesses sort of 30, 40 years ago. They're capital light kind of businesses. And I thought to myself, well, they might have been 2, 3, 4 years ago, but right now they are not. Those businesses are spending vast amounts of money on things that depreciate fast. This isn't like a property that you can depreciate over a decade or so. This is these are chips that are pretty much bent out after 3 years. Some of them carry on for 3.5, some of them carrying on for 4. But I can't imagine many of these companies are looking forward to having 4-year-old NVIDIA chips in their data center, Steve. I think they'll be getting changed a lot quicker than that, or being moved into other things. The other problem is that the heavy load that's going to get put through these, if AI takes off as much, is also going to make these chips burn out faster than they normally would. So, yeah, these are not capital light businesses anymore. They're still wonderful businesses. Let's not beat around the bush here. The top lot of businesses are still incredible businesses, but they're not capital light businesses anymore. So maybe this, Steve, is the thing that eventually gives us your reversion to the mean on PEs. Maybe this is the thing we finally look for. The guys at the top become more like old businesses rather than new ones. Who knows? But yeah, I think that's generally. I feel like Terry Smith has maybe perhaps lost his way a little bit, and I think this does happen to people. And I don't want to accuse him of falling foul of new investor tactics, but you can tend to chase gains when you're not doing very well, and you can dial up risk and sell things that you would have otherwise have held, and focus on one thing that might be working, ignoring the other things that aren't. And there's a faint whiff of that from his last couple of letters and his changes that have happened and the things that he's bought and the things that he's sold. I don't know, Steve, if you want to add any colour on that before we shuffle on, but yeah, I think there's a little bit of pressure coming through here, and you can read the overall sort of letter reads as if somebody who was forced to write it, rather than when we've read his first one, Steve, where he seemed to be enjoying himself a little bit more.
It reads like a lot of excuse making to me, but I'm only sort of mildly critical of that in the sense that man is a fund manager, man is underperforming. You better have an excuse rather than saying, yeah, don't really know what happened, guys, but we seem to have gone backwards instead of forwards. Terry Smith does actually quite nicely in some ways point out the difficulties of being a fund manager, and one that he points out that leads both you and I towards 3i in the BritBox is the fact that when you take in investor money, it inevitably shows up at the wrong time. It shows up at the time when you're doing very well, which basically means everything you own has gone up a lot. And everyone says, great, now go and buy me some stuff. And you think, well, I don't know what to buy at the moment. Everything seems quite high. When it all goes down and goes the wrong way, and you say, guess what, guys, great news, everything's 30% cheaper. No one's suddenly interested in buying anymore because you lost a load of money last year. And things like that. And I think the inevitable need to make excuses for underperformance over a short but now slightly extending period. I mean, this letter is about the 6 months, which is a short period. to me, kind of, it's the sort of thing I feel a bit sympathetic for. If we were reporting portfolio stuff and saying we'd underperformed over 6 months, we'd kind of say, oh, well, and get on with it. But that doesn't really work when you're running other people's money, and it definitely doesn't work. That bit I'm sympathetic for, but it definitely doesn't work when you're taking fees for running other people's money. And that bit I'm kind of less sympathetic to. The main difference is we don't charge anybody for this stuff. We're not saying pay us 1%. By the way, we've lost another one as well. We're busy just doing our own thing, I guess. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.